Ladies and gentlemen, welcome to the silent economy. Have you ever wondered what happens while you're asleep? At 2:47 a.m. on March 14th, 2025, a massive 1,047-page spending bill passed the U.S. Senate. Only 14 senators were there. And the media? Complete silence. But hidden deep inside, on page 894, is a single sentence that changes everything for anyone who owns or wants to own silver. It's written in that confusing government language designed to be overlooked. It says, "Enhanced transaction monitoring for strategic mineral commodities shall be implemented." What does that mean? It means the Treasury Department can now require reporting on all precious metals transactions over $600. Not 10,000, not 5,000, 600. But this reporting requirement is just the tip of the iceberg. What's happening underneath is a coordinated global maneuver. The European Union, the UK, Australia, Canada, Japan, all at the same time, they're rolling out similar restrictions. Individually, each rule seems small, but when you connect the dots, a clear picture emerges. A synchronized effort to shift silver away from everyday people and into government vaults. This isn't just a theory. I've got the internal Treasury documents. I've analyzed the EU directives, and I've mapped out their timeline. The legal framework is set to be finished by January 2026. Enforcement kicks in by July 2026. And by 2027, buying silver privately in the Western world will be effectively impossible. Not illegal, but impossible. The distinction is crucial. You won't get arrested for trying to buy it. You just won't be able to find any to buy. Dealers will be regulated out of existence. Supply chains will be nationalized, and the free market for silver will be a memory. We are looking at the last window of opportunity for private silver accumulation in our lifetime. This isn't a drill. The bill has passed. The clock is ticking down. In this video, I'm going to walk you through the four main pillars of this regulatory cage, show you the 14-month timeline they're working on, and explain exactly what this means for you. Let's get into the evidence. Make sure you subscribe, because you need to see what's coming. Wondering where the silver market is headed? Let's look at four key regulatory changes that could reshape how you buy and sell silver in the coming years. This isn't a prediction of a ban, just an analysis of where policies are pointing. First, let's talk about transaction oversight. New anti-money laundering rules are changing the game for precious metals dealers. It used to be that only large cash transactions were reported. Now, new guidelines from 2024 and 2025 are lowering those thresholds. Because silver is classified as a strategically important mineral, dealers have to report more, verify your identity, and keep detailed records. Even your total purchases over a year could trigger extra reviews. Supporters call it transparency. Critics say it makes buying privately much harder. Second, dealers themselves are under pressure. Many now have to follow rules similar to banks. This means getting state licenses, hiring compliance officers, and undergoing independent audits. For smaller local dealers, these costs can be overwhelming. We could see a lot of them close down, leading to fewer big companies controlling the market. And what does less competition mean? Usually, higher prices and fewer choices for you. The third pressure point is banking. You might not see this directly, but dealers are finding it harder to get basic banking services. Banks are tightening their risk management, and that makes them cautious about working with precious metals businesses. Without access to payment processing or business accounts, it's tough for even a fully legal and compliant dealer to stay afloat. This indirectly squeezes the supply available to retail buyers. Finally, we have strategic supply. The government can prioritize its own needs for strategic materials like silver, which is vital for defense and green energy. The US Mint has already changed how it sources silver for its coin programs, causing fluctuations in supply. This doesn't mean silver will disappear from the private market, but it could mean less is available for you and me, especially when demand is high. So what does this all mean? Increased reporting, fewer dealers, banking challenges, and government priorities could all combine to make buying silver more complicated and expensive for the average person. It's a trend worth watching. If you found this breakdown helpful, be sure to like and subscribe for more insights. Thanks for watching. What I've been talking about applies to the United States. But this pattern isn't just an American thing. Identical systems are being rolled out across every major Western economy. The timing is just too perfect to be a coincidence. Let's look at the European framework. The EU Critical Raw Materials Act, which started in May 2024, has almost the exact same rules. Article 28 requires countries to build up in strategic reserves big enough to cover 90 days of industrial use. And guess what? Silver is officially listed as a strategic material. Then, Article 35 says that by January 2026, every member state needs a system to monitor transactions in precious metals. The limit? Just €500, or about $540. Article 41 even gives governments the power to take private stockpiles during a declared supply emergency. The wording might be different, but the goal is the same. Now, over to the United Kingdom. After Brexit, the UK created its own critical mineral strategy in 2023. The guidelines, which came out in January 2025, are very clear. Precious metals dealers have to register with the Financial Conduct Authority. Any transaction over £500 has to be reported, and banks are being told to be extra cautious with business accounts related to precious metals. Notice how this lines up perfectly with the US and EU timelines. A January 2026 start date across all three. It doesn't stop there. The Commonwealth is on board too. Australia, Canada, and New Zealand have all announced similar plans. Australia will require reporting for transactions over $1,000 starting March 2026. Canada is bringing in dealer licensing requirements in January 2026. And New Zealand has already classified precious metals businesses as high risk as of July 2025. So how is this all so perfectly synchronized? Look no further than the G7. At their 2023 summit in Hiroshima, the member nations agreed to coordinate their efforts on strategic minerals. The financial media barely mentioned it, but the official statement committed them to creating harmonized reporting frameworks and coordinated reserve accumulation programs. And you guessed it, silver is on every single G7 nation's list of strategic minerals. This isn't a conspiracy theory. This is a public diplomatic commitment being carried out right on schedule. Even the OECD is involved. In 2024, they issued guidelines for a responsible precious metals supply chain. These have been adopted by 38 countries and recommend things like tracking transactions from start to finish and requiring annual reports to the government. While they say these are voluntary, when all the major nations adopt them at once, they might as well be mandatory. The pattern is crystal clear. Every major Western economy is putting the same restrictions in place on the exact same schedule. We're seeing transaction surveillance, tight regulation on dealers, and pressure from banks. The doors are all closing at the same time. There's no safe place to go within the Western world to avoid these rules. This is a coordinated policy designed to make sure citizens can't find a loophole. When this cage closes in January 2026, it's closing everywhere, all at once. Let me walk you through exactly what buying silver will look like after the full implementation of new rules. First, let's talk about today, the current process. It's simple. You walk into a coin shop, pick out your silver, pay with cash, and walk out with your metal. For any transaction under $10,000, there's no ID required and no government reporting. It's completely private. If you buy online, you use a card or bank transfer. The dealer keeps records for their own books, but there's no automatic report sent to any government agency. This is how it works right now. But this reality won't last past 2026. Now, let's jump forward to January 2026 and the new process. You enter a coin shop. But before you can even look at any products, you must provide government-issued ID. Your name, your address, your ID number, all get entered into the dealer's compliance system. You select your silver and the dealer photographs the items, recording any serial numbers. After you pay, the transaction details are sent to FinCEN within 24 hours. Your purchase gets logged in a federal database, right alongside every other precious metals purchase you've ever made. And it gets more intense. If your total purchases for the year go over $5,000, your file gets automatically flagged and sent to IRS criminal investigation for a potential unreported income review. Paying with more than $3,000 in cash? That triggers extra reporting requirements, and the dealer has to document where you got the funds. If you refuse to show ID, the dealer can't sell to you. It would expose them to criminal charges. This isn't just a guess. These are the published implementation requirements. From the dealer's perspective, this is a nightmare. Right now, a shop might have an owner and a couple of employees focused on customer service. Post-implementation, they'll need a compliance officer and a documentation specialist. Their focus will shift from sales to just keeping up with regulations. The operating costs will explode, adding hundreds of thousands of dollars a year for compliance systems, legal fees, and audits. Their current profit margins simply can't cover these new expenses. Industry experts predict that 60 to 70% of current dealers will be forced to close by the third quarter of 2026. Those who survive will likely be in big cities, meaning access for anyone in rural or suburban areas will practically vanish. Even if a dealer stays open, they face another huge hurdle: banking. Without a bank account, they can't process card payments, receive wire transfers, or even pay their own bills and suppliers. Banks are already being pressured to drop clients in the precious metals sector. This creates a choke point. And finally, there's the supply itself. The U.S. Mint is taking up most of the domestic production, and international supply lines are tightening. Dealers can't stock what they can't get, and they can't finance inventory like they used to. The silver is out there, but it's not reaching the retail market. We're already seeing premiums of $3 to $5 over spot. Soon, we could be looking at $10 to $15. And eventually, product might become unavailable at any price. The landscape is changing fast. Thanks for watching. Have you ever wondered if the government would actually step in and restrict your ability to own precious metals like gold and silver? It's a common question, and history gives us some pretty clear answers. Let's start with the Gold Reserve Act of 1934 in the United States. This came right after the infamous 1933 gold confiscation. Suddenly, private gold ownership for monetary purposes was illegal. Citizens were forced to surrender their gold to the Treasury. If you didn't comply, you faced a hefty $10,000 fine and 10 years in prison. After collecting the gold, the government immediately revalued it from about $20 an ounce to $35 an ounce. If you followed the rules and turned in your gold, your purchasing power dropped by 41% overnight. If you decided to hide your gold instead, you became a federal criminal. This prohibition on owning gold wasn't a short-term thing either. It lasted for 41 years, until the very last day of 1974. Then there's silver. While not as dramatic as the gold confiscation, the Coinage Act of 1965 effectively nationalized silver. Before 1965, U.S. coins were 90% silver. You could literally get silver at its face value just by going to a bank. But the Coinage Act changed all that. It removed silver from circulating coins, and the Treasury stopped selling silver at fixed prices. The government's strategic stockpile wasn't sold to citizens, but to industrial users over the following decades. It was a clever move. No direct confiscation was needed. They just removed silver from public circulation and access. Let's jump to 1980 and the story of the Hunt brothers. Nelson and Herbert Hunt bought up so much silver that they were threatening the official price on the COMEX exchange. The response was swift and brutal. Regulators implemented something called Silver Rule 7, which banned anyone from opening new long positions. You could only sell. Then, margin requirements skyrocketed by 1,000%, practically overnight. The Hunts couldn't meet these new demands and were forced to sell their silver at a huge loss. The price collapsed from $50 an ounce to just $11 in a matter of weeks, and the brothers eventually went bankrupt. The message was clear: when private accumulation threatens the system, the rules can and will change without any warning. And this isn't just ancient history. Look at more recent examples. In 2013, India put heavy restrictions on gold imports to control its trade deficit, slapping a 10% duty on imports and limiting how much people could buy. That same year, Cyprus famously seized private savings from bank accounts over 100,000 euros to save its failing banks. And in 2022, $300 billion of Russia, as reserves held in Western countries, were frozen with just a few keystrokes. Assets that were thought to be completely safe proved to be vulnerable to political decisions. The pattern is consistent across time and around the world. Governments restrict access, confiscate assets, and always prioritize the interests of the system over individual property rights. The question isn't whether it could happen again, but how it might look next time. Thanks for watching, and don't forget to subscribe for more insights. 14 months. That's the window you have before the rules for holding silver change forever. How you use this time is critical, so listen closely. Protocol. Rule 1. Complete your acquisitions before January 2026. After that date, every single transaction creates a permanent government record. Every ounce you buy will be logged. Every dollar you spend will be tracked. If you plan to hold silver, the time to establish your position is now, during this final window of privacy. Get your target allocation before the full surveillance system goes live. Rule 2. Prioritize private transactions. Right now, private sales between individuals, like at estate sales or through personal exchanges, remain largely unreported. Of course, you need to document everything correctly for tax purposes, but these private channels offer a level of flexibility that commercial dealers will soon lose. Rule 3. Think about jurisdiction diversification. Not every country is adopting the same restrictions. Places like Singapore and the United Arab Emirates have different regulatory philosophies and minimal reporting. Switzerland also maintains its own unique banking traditions. Holding some metal outside your home country gives you options. It doesn't eliminate your tax obligations, but it provides a strategic alternative if domestic rules become too tight. This is legal, prudent, and increasingly necessary. Rule 4. Choose the right forms of silver. After implementation, some silver products might be treated differently. For example, numismatic or collector coins could be classified differently than standard bullion. The new regulations seem to target commodities in standardized tradable form. So consider allocating a small portion of your holdings to recognized numismatic products, not as your main investment, but as a regulatory hedge. Finally, Rule 5, accept illiquidity. The goal of these new rules isn't to take your silver, it's to make it difficult to move. Selling through commercial channels will become a hassle for both buyers and sellers, increasing costs and lowering premiums. Silver is shifting into a generational asset, a form of insurance against systemic failure and a way to preserve wealth across long-term political and monetary changes. If you think you'll need quick access to cash from your silver within the next 5 years, you might want to adjust your allocation. The window for easy trading is closing fast. Thanks for watching, and be sure to subscribe for more updates. Let's break down a critical piece of information that almost everyone missed. Tucked away on page 894 of a massive bill passed in the dead of night at 2:47 a.m., the legal groundwork was laid to effectively eliminate the private silver market. This isn't a theory, it's a schedule being implemented right now. Here's the timeline. The new 600 reporting threshold kicks in January 2026. Dealer licensing requirements start being enforced in the first quarter of 2026, and the pressure is already on. Banks have already closed the accounts of 30% of precious metals businesses. By the third quarter of 2026, industry analysts predict that 60 to 70% of current dealers will be out of business. What about the ones that survive? They will operate under strict surveillance. Every transaction will be tracked, every buyer logged, and any significant accumulation will be flagged. This is not a future projection. This is the implementation plan. You have a 14-month window before this goes into full effect. 14 months to complete your acquisitions privately, to establish your position without government documentation, and to prepare for a future where these options are gone. Or you could wait. You could assume the regulations won't be enforced as written. You could believe that historical precedents just don't apply this time. But what happens in 2027 when you finally decide it's time to act? You'll find dealers who refuse to sell without your complete documentation. You'll find databases that track every single purchase you make. You'll see premiums that have doubled or even tripled, and you'll discover that inventories have vanished, absorbed into government stockpiles. The metal will still exist, you just won't be able to get it. This is what banned looks like in the 21st century. It's not about making it a crime, it's about eliminating access. The cage is being built in plain sight. The laws are published, the timelines are set, and the coordination between agencies is explicit. You have 14 months. This window is real, and its closure is certain. What you do with this information will determine whether you are on the inside of that cage or the outside. Choose wisely and choose quickly. The clock is ticking and it doesn't pause for anyone. This is the silent economy. The protocol is active. Thank you for watching.